Welcome back to the deep dive, where we take complex financial concepts and try to turn them into immediately useful strategic insights.
That's the goal.
Today, we are plunging into the fundamental hierarchy of business costs. And, if you run a company or manage a budget or even just analyze investments, you know this intuitively.
Mm.
Not all costs are created equal. A dollar spent on, say, rent is just fundamentally different from a dollar spent on raw materials, especially when you're trying to make big decisions about the future.
Exactly. I mean, the real challenge in business analysis isn't just counting the dollars flowing through the system.
No.
It's knowing how to categorize those dollars.
Mm.
Because the category you pick, well, it changes entirely based on the decision you're actually facing.
Right.
So our mission today is really to give you that mental toolkit, the different lenses, to view every cost that crosses your desk, making sure you always pick the right tool for the job.
And right out of the gate, we found something in our source material that I think sets the stage for everything else. It's this idea that there are critically important costs that are not formally tracked in a company's, traditional accounting system.
Yeah, that's a huge point.
I'm talking about opportunity costs. They are absolutely crucial for strategy, but the bookkeepers, they never write them down.
I don't.
Which immediately tells you that you need to look beyond the general ledger to really get what's going on.
That fact it fundamentally highlights the tension between what we show investors, that's external financial reporting, and what we use for internal managerial decision-making, which is really our focus today.
Okay, so where do we start?
We have to ground ourselves in the first, most crucial categorization, how costs behave when business volume changes.
Okay, so let's unpack this framework that really determines your whole profit structure. We're talking about behavior-based costs.
The split between fixed versus variable. This is the absolute foundation of any kind of short-term planning. A fixed cost is defined as one that does not change in total within a relevant range of production or sales.
So whether I'm producing 100,000 units or...
Nothing at all.
Right, or I shut down the factory completely this month, my annual property insurance premium or my building rent, that stays constant. That cost is, well, it's inescapable in the short run.
Precisely. And so our costs, like the salaries of the executive team, these are period obligations. You pay them no matter what the activity level is.
And the other side of that coin is the variable cost.
Variable costs change directly
Mm-hmm.
and proportionately with changes in the level of sales or production.
So if you double production, your variable cost should roughly double.
Exactly. The materials costs for the product itself or, sales commissions that are based on volume, those are perfect examples.
Okay, I get the definitions, but let's dig in a bit.
Mm-hmm.
Why does this framework matter so much strategically? I think a lot of our listeners already know the difference between rent and raw materials. So why the deep dive here?
Because this distinction, it's what determines your operational leverage. If a business has a high proportion of fixed costs, let's say they invested a ton in automated machinery, they have really high leverage.
Okay.
And that means that once they hit their break-even point, every single additional sale yields a massive amount of profit because all those fixed costs are already covered.
Ah, I see. So a high fixed cost structure is high risk, but it's also high reward. If demand drops, you're stuck paying those costs anyway.
You're stuck.
But if demand soars, your profits just explode. That's the real insight here.
That's it. But we do need to add a layer of real-world nuance because not everything is purely fixed or purely variable, right?
Sure.
What about a semi-variable cost, like electricity or maybe certain administrative labor? Where does something like that fit?
That's a great question. You might have a fixed base charge for your utility service, but then the actual usage varies with production.
Right. They don't fit neatly into either box.
So what do you do?
Well, managers use various methods to separate that mixed cost into its fixed component and its variable component. It can be a bit messy, but it's critical. You need that pure variable cost data to accurately predict the cost of the very next unit you produce.
And that's the whole point of the exercise.
Exactly.
Okay, so understanding volume sensitivity is vital for forecasting, but frankly, those definitions are kind of useless when my accountant needs to close the books.
Totally different world.
Right, for reporting earnings to shareholders, you need a completely different lens, which brings us to our second segment. The distinction between product versus period costs.
And this categorization is driven purely by financial reporting rules. It's all about the timing of when a cost becomes an expense.
So it's the difference between costs needed to make the thing and costs needed to, well, sell the thing.
You've got it.
Okay, so let's start with period costs.
All right. These are all the costs incurred outside the manufacturing facility. So sales, general admin, marketing, R&D,
And since they aren't tied directly to creating a physical inventory,
they get expensed immediately. A period cost is reported as an expense in the period in which it happened. It hits the income statement right away.
but the costs incurred inside the factory, the ones tied to the actual creation process, those are treated almost magically. These are the product costs. Why are they so different?
It all comes down to the matching principle in accounting.
Mhm.
If you make a product in January, but you don't actually sell it until April,
Okay.
the rule says the cost of making it shouldn't be recognized as an expense until April to match it with the revenue from the sale.
Let's see.
Therefore, product costs have to stick to the product. They're first reported as an asset inventory on the balance sheet.
And then?
And only when the product is physically sold do they transform into an expense, the cost of goods sold.
So product costs are part of the asset's value until the point of sale. That makes sense when you put it that way. And our source material breaks these down into the famous 3 types every manufacturer has to track.
We start with the most straightforward one, direct materials. This is the cost of the primary raw materials that become, an integral part of the finished product.
So if you're building a bookshelf, it's the wood. If you're selling bottled water, it's the water in the plastic bottle.
Precisely. Second, we have direct labor. This is the cost of wages for workers who are physically touching and transforming those materials into the finished goods.
The person on the assembly line.
Yep. Compensation of the auto workers on the line or the baker mixing the dough.
And finally, we have the category that causes the most confusion, manufacturing overhead.
Ah, yes. The catch-all.
It sounds simple, but this is where it gets complicated.
It is. It's the catch-all for all other factory costs that are not direct materials or direct labor. And here's a crucial link back to our first segment. Manufacturing overhead is a hybrid. It includes fixed costs, like the factory supervisor's salary.
Or building depreciation, right?
It includes variable costs, like the electricity used to run the machines, or miscellaneous indirect materials like glue or screws.
But the real operational headache with overhead isn't defining it. It's the allocation problem, right?
Oh.
Figuring out how to get it out of that big bucket and onto each individual product.
That's where so many pricing and inventory decisions go wrong. Accountants have to choose a basis, maybe machine hours, maybe direct labor hours, to arbitrarily allocate those shared costs.
If you get that wrong.
If you get it wrong, you might end up overpricing the products that are actually cheap to make and essentially subsidizing the products that are really expensive to produce. It's an estimation game, but a necessary one for financial reporting.
Absolutely. So that external reporting system, product versus period, is necessary for shareholders, but honestly, it's often useless if you're a manager trying to decide whether to launch a new product line next year.
Or whether to retire some old machinery.
Exactly. For that, we need the managerial lens, which brings us to segment 3, costs for decision-making.
Right. And we need 2 primary ways of looking at costs here. One for segment analysis and one for future planning. Let's start with the segment analysis part, direct versus indirect costs.
And this classification is critical when management is thinking about whether to keep or to drop a product line or a department or even a customer segment.
Right. A direct cost is a cost that is truly, and I mean truly, created by that specific segment.
So the test is what?
The test is, if the segment is dropped, does the cost disappear? If the answer is yes, it's a direct cost. Think about the marketing budget that's dedicated only to product X.
If product X goes away, so does that budget.
Gone. But then you have indirect costs. These are costs that are assigned or, allocated to that segment like a portion of the CEO's salary, but they are not actually caused by it.
And that's the danger zone.
It's a huge danger zone because if management decides to drop the segment, thinking they'll get rid of that cost, they find out the hard way that the indirect costs assigned to it are still there.
Because the business as a whole was incurring them anyway.
Exactly. You just end up redistributing that burden to whatever segments are left. You don't actually eliminate the cost.
I can see the distinction, but isn't there a high risk that this just becomes about internal politics? Managers will always try to define costs as indirect to preserve their own department's budget.
Oh, it is. It's absolutely right for that. And that's why financial analysts have to be so rigorous in identifying true cost causality. The decision has to be based on cash flow, not on some arbitrary allocations on a spreadsheet.
That makes sense. Okay, now let's shift gears to future planning. This is the philosophical distinction between differential and sunk costs. This is all about what costs matter for tomorrow's choices.
Right. And a sunk cost is defined as a past cost, a cost that cannot be changed by any decision made right now or in the future. It's history.
So think about the $2 million you spent last year developing a piece of software that didn't work out. That money is gone.
It's gone.
No decision you make today about whether to keep funding the project or kill it will ever bring that $2 million back.
And this is so critical because smart decision-making requires you to ignore sunk costs completely. What matters is the differential cost.
And differential costs are future costs that can be changed by a decision you make now.
Exactly. If you're comparing the cost of buying raw materials versus making them in-house, the difference in those future costs is the differential cost you have to focus on.
But if sunk costs are so irrelevant, why do people struggle so much to ignore them? Why do we see companies constantly throwing good money after bad?
It's largely psychological. It's an aversion to acknowledging failure. It's what people sometimes call the Concord fallacy.
Right.
People feel this deep pressure to justify the investment they already made, hoping that just a little more spending will turn that past failure into a success. They're looking backward, not forward.
When they should be looking forward.
They must. Bringing in $1 million of new funding to a failed project only makes sense if the potential future return from that million is better than the return you could get putting that million somewhere else.
The past $2 million is just noise.
It's noise. The decision must focus only on that differential cost.
So sunk costs are noise, differential costs are the signal. And this logic leads us right into our final segment, which is about the strategic imperative of cash and, well, the cost concept that started our entire dive.
Yeah, and when we talk purely about cash flow, we can use the simplest concept of all, the out-of-pocket cost.
The name really says it all. These are costs that involve the actual outlay of cash, or using some other tangible asset that requires funding, like equipment you have to buy or replace.
It's the literal, immediate strain on your liquidity.
Right. And finally, that brings us back to the concept that separates the accountant from the strategist: opportunity costs.
And our source material confirmed it, still not tracked in the formal accounting system, even though they're so profoundly important.
So just to define it again, opportunity costs are the benefits you did not receive because of an action you did not take. They represent the value of the best alternative you gave up.
Let's use a business scenario. Say a manufacturer owns a warehouse outright, no mortgage.
Oh, okay.
They're currently using that warehouse for, let's say, cheap, disorganized inventory storage. The out-of-pocket cost for that storage is almost zero, maybe just some utility bills.
But the opportunity cost is huge.
It could be massive. If they chose to rent that warehouse out, they could be generating, say, $50,000 a month in rent.
Or they could reconfigure the space and launch a new high-margin production line that generates $100,000 a month in profit.
Exactly. So if the manager only looks at the low out-of-pocket cost of their current storage setup, they'll be completely blind to the $100,000 strategic opportunity they are actively forfeiting every single month.
And this really connects all the lenses we've discussed.
It does.
It's fascinating. You have fixed variable for volume, product periods for reporting, sunk differential for future choices, and yet the ultimate strategic decision must always include that one non-tracked element: the opportunity cost.
That is what separates a good analyst who can track the ledger from a great strategist who sees the true cost of inaction.
A perfect summary.
Absolutely. So you now have 4 key frameworks to analyze any business expenditure. Just remember, you have to select the correct categorization for the job. Are you analyzing volume sensitivity?
Use fixed and variable.
Are you reporting to shareholders?
Product and period.
Are you evaluating a future project? Use differential and sunk. Understanding the definitions is just the first step. Knowing which lens to apply, and critically, remembering the costs that aren't even on the page. That is the true lesson here.
And to leave everyone with a final thought to mull over, consider the raw power of recognizing a sunk cost for what it is: a final, irrecoverable expenditure. If you fully, truly accept that finality, how does that fundamentally alter the way you approach new investments or projects? How does that realization force you to focus relentlessly only on the potential future return, ensuring you never chase losses, but instead pivot immediately to the highest opportunity cost alternative?
That discipline, I think that defines strategic success.
Food for thought indeed.
It always is. Until the next deep dive.